As you may already know, we always make sure to list the best of the best stocks on the market, and today I came up with some new stocks that you probably didn't even know about that are growing steady and should give a great profit by the end of 2021. Before we get into it, do me a favor and hit the like button and subscribe. Now, without wasting any more time, let's get right into it. Number 1. NRG Energy. NRG Energy, together with its subsidiaries, operates an energy company in the United States. It operates through generation and retail segments. The company is involved in producing, selling, and delivering electricity and related products and services to 3.7 million residential, industrial, and commercial consumers. It generates electricity using natural gas, coal, oil, solar, nuclear, and battery storage. The company offers investors a profitable dividend and is promising a fairly bright future. It makes sense that dividend-focused investors would be interested, particularly given the general conservative view most people have about the utility sector. The incredible stock price that increased at the beginning of 2020 basically means to signal that NRG Energy has turned a corner. In my opinion, the company seems to be at a really good start. Number 2. Virtu Financial. Virtu Financial is one of the largest high-speed trading firms, providing market making and execution services. Virtu's business thrives in volatile environments like 2020, making the stock a worthwhile hedge during market turmoil. The company has been paying a steady $0.2 share. Debt is not a concern to people anymore thanks to the recent operational performance and subsequent payments Virtu offers. People want their problems solved, and Virtu Finance seems to solve the financial ones, which are the worst. The stock has also shown a great growth over the past year, which adds more points to why you should buy this one. Number 3. DocuSign. DocuSign, also known as DOCU, has been an investor's favorite stock as it has returned nearly 400% since a bit under 2 years ago. Docu has been a clear beneficiary of the pandemic as social distancing restrictions nationwide gave mission-critical growth to the e-signature market. Can the growth continue beyond the pandemic? Docu was capitalizing on secular tailwinds even prior to 2020, and it's arguable that the pandemic merely accelerated the growth. I expect Docu to continue growing the e-signature market moving forward. Shares aren't cheap, and I'll outline a covered call strategy that can help you make shares easier to hold onto in the near term. It's important to understand why I'm optimistic about the stock future. Docu has seen accelerating growth rates over the past year because businesses were more or less forced to move signatures online. Because billing growth is very strong, this implies that Docu may continue to see strong revenue growth moving forward. If billing growth was weak, then one might harbor justified suspicion that forward revenue growth might not mirror past revenue growth. Docu is not yet profitable on GAAP basis, but it has made meaningful progress toward generating positive free cash flow. Docu is projected to earn $1.76 billion in subscription revenues over the next year. As of recent prices, shares trade at 22.7 times that number. That still isn't that cheap, and it's understandable if many investors want to wait for a better entry point. While the stock looks like a potential market beater over the next several years in spite of the lofty current valuation, investors can take advantage of high implied volatility to improve their returns and reduce their risk. One could purchase 100 shares of Docu for $204 per share and sell a covered call option with an expiration date of January 22 and strike price of $270 for $21. If Docu stays at $204 by the next year, then it would produce a 10.3% return based on the options premium. We would lose money only if Docu drops below $183 per share. At that price, shares would trade at 20.4 times sales, which appears reasonable in light of the consensus estimate of 32% growth for the then following 2022 fiscal year. Our max upside is if Docu trades up to $291 per share, representing 32 times sales, approximately the same multiple it currently trades at. Shares would return 43% in that scenario, which should be more than enough to beat the market. Number 4. XPeng. XPeng is a smart electric vehicle maker that's based out of China. Founded in 2015, the company draws many comparisons to Tesla in its production design, technology, self-driving capabilities, and self-supercharging network. While NIO receives far more attention and publicity, I think XPeng is more similar to Tesla than NIO is. Chinese EV stocks reached an all-time high in early February, but have sold off lately due to investors chasing more attractive bond yields and the temporary delay in deliveries caused by the Chinese Lunar New Year. The P7 sedan is XPeng's most popular EV, and the company has delivered more than 20,000 P7 sedans as of March. XPeng is 1/3 of NIO's market cap, yet provides a ton of upsides if deliveries continue to rise. The XPeng only produces 2 electric vehicles at the moment, yet both electric cars are built with attractive features like super long range abilities, self-parking technology, and fast charging benefits. The G3 SUV is the longest range compact SUV in China, while the P7, XPeng's best-selling vehicle, is a strong competitor to the Tesla Model 3. XPeng's smaller model lineup allows them to be more focused on improving battery technology and software updates, while competitors like NIO become less focused with several electronic vehicle launches. XPeng stole the playbook from Tesla by launching its own supercharging network to serve its customers. This will help build more loyal customers who use XPeng's charging network as deliveries increase in the long run. By owning its own supercharging network, XPeng can generate additional charging revenue, unlike legacy OEMs who only profit from upfront car sales. The EV industry possesses an amazing flywheel effect where every electric vehicle sold increases the demand and awareness for companies like XPeng without needing tons of advertising. After the recent electric vehicle sell-off, XPeng's stock currently trades around 20 times revenue. That's a fair value for one of the better Chinese EV companies right now. The P7 sedan should continue selling like crazy, and I can't wait to see when March deliveries update. In my opinion, XPeng stock will continue to grow as the company will eventually expand its sales worldwide. Number 5. Amgen. Amgen, also known as AMGN, is a company I consider to be highly profitable. With historical performance, dividend growth, good fundamentals, and good management, it's really one of the better and more appealing companies for investment in the sector. In the past, investors say the company outreached their performing goals totaling above 10% annual rates for return. In the past 10 years, the company has averaged almost 10% estimated return in terms of earnings, which comes to elite levels. You can see an almost perfect pattern of slight volatility between 12.5 times and 15.1 times ratio during that time, with only short times of real stability for the stock. This is a company where short-term growth expectations or headwinds tend to impact the share price, after which the market reacts and realizes the price is too cheap. Ideally, we'd want to pick up the company at something along 11 to 12 times earnings, but waiting for this is a fool's game as I see it. The current set of expectations is simple and, based on a relatively moderate growth of around 5%, with a 2% growth for 2021. Amgen is a great pharma company, and I hope it grows like this for a long time. It's also a company that has a tendency to move up and down rapidly in short intervals as a result of short-term earnings, tailwinds, or headwind reports. The key is valuation and investing in the company at the good price. Anything under $235 is where I'd consider Amgen buyable, but I wouldn't really start buying anything over $225, and I wouldn't start really pushing it until it drops below $220. That means for the company's current valuation in a grossly overvalued market, it's just a great investment altogether. However, it's not the best one available. That honor goes to other companies, which shows conservative upsides of more than 20% CAGR on a 3-year forecast basis. Any undervaluation of quality such as this one merits mentioning in this market, and if you, like me, are overexposed to some of the higher upside companies, you may consider Amgen to be a goldmine here. Alrighty, that was the roundup of just 5 of the many stocks I think you should invest in too. Of course, the information displayed on this video may not come out as expected, and this is why I also always encourage people to do their own research as well before investing. But by doing my research, which is what I do best, I came out with this listing. Now it's your time to show me a stock you think will be profitable throughout 2021. Let me know which one you're thinking of in the comments below. Also, don't forget to like, subscribe, and hit the bell button. See you on the next one.